But thank you all for joining us. Cathie, it's a delight to have you again. Obviously, we've enjoyed it when you've been here in person. But in the digital age, we can still get to hear your thoughts and your insights. So that's fantastic. So thank you for that. And with the markets have been volatile, the tech sector and disruptive innovation have clearly been beaten up in the markets over the past 12 months, and we've seen that come through in performance. So, what's happened? What's gone wrong? Where does it go from here? What's your outlook? We're in your hands for the next 20 to 30 minutes, and we'll take some questions as well.
Yes, and George, thank you very much for inviting me. If there are questions and you want to interrupt me at any time, please do, because I don't see, I do see Q&A here. Okay, very good. So I think the underperformance started in mid-February a year ago. The decline has been quite severe. And it started because of inflation and interest rate fears. Once vaccinations were underway, seems like the market decided on to the next thing. And what I believe we've seen is an extreme fear of inflation and interest rates. Inflation definitely went higher than we thought. We thought it would go higher because of supply chain issues. We did not think supply chain issues would last 2 years. And so if they had cleared up, I think we would have been fine. I think the fear of inflation is misplaced. I know that transitory is no longer a fashionable word, so I won't use it, but I will tell you that there are deflationary forces, both secular and cyclical. And the secular, I've probably said this in many of your presentations before, technologically enabled innovation is deflationary in nature. You know about Wright's law, and we're seeing, just to give you an update, artificial intelligence costs when you combine hardware and software are dropping 60% per year, and industrial robot costs for every cumulative doubling of units produced are dropping 50%. So powerful deflationary forces. The bases are low. They are scaling pretty quickly. So they will start to move the needle, we think, quite substantially. And then on the other side, from a secular point of view, we're going to see a lot of disintermediation and disruption of the traditional world order. And particularly in transportation, financial services, autos, still retail, so much so that we believe that companies that have not invested enough and have manufactured earnings by leveraging up to buy back shares or to pay dividends, that they are in harm's way, and their obsolete products will have to, they'll have to cut prices to move them and service their debt. So those are the secular. On the cyclical side of inflation, again, supply chain has been the biggest reason, I think. And I think because of supply chain issues, we have had manufacturers, wholesalers, retailers, double and triple ordering, so that in the fourth quarter GDP here in the United States, we had a record-breaking inventory buildup. Now, everyone's still talking about supply chain, and yet we have a record-breaking inventory buildup. What's going on there? The consumer is turning off. The consumer is very upset at the loss of purchasing power, especially when it comes to food and energy. And we are looking at food and energy price hikes here, and even more so given the conflagration in the Ukraine, as a massive tax on the global economy. We think the risk of recession has increased dramatically here, and that the energy and food prices are not going to cause a wage price spiral. So partly because of a recession or near recession, and partly because productivity gains are evolving, are beginning to gain traction. And productivity gains basically offset a good part, will offset a good part of the wage gains that we expect. So they will be passed through somewhat to wages, but also to corporations. So the inflation news, I think, is going to surprise on the low side of expectations. And you'll see the rally in the market today as the war seems to have started in the Ukraine, or the invasion. The markets took off because all of a sudden the fixed income, the equity market took off because the fixed income markets began to agree with this point of view that this rise in energy prices and probably more and more weakness in Europe is going to end up slowing the economy down so much that the Fed will not raise interest rates. The last year has been about one strategist and economist after another, basically trying to outdo one another, saying, we think it'll be 3 increases in the Fed funds rate, or 5 or 7, and recently 9. And we actually think the number is 1, and that it will be in March. And the reason we think this is the yield curve is supporting us. The yield curve, the difference between the 10s and the 2s, peaked at a roughly 160 basis points last March, and has been flattening ever since. We're now roughly 40 basis points. So what the bond market, in its wisdom, is saying is, we don't buy this inflation narrative, or we don't believe that the economy is going to continue to expand, or both. And the equity markets with this invasion is finally starting to say, okay, maybe the energy price has gone so far that it really is a tax increase that will support the point of view that the bond market has been telegraphing over the past year. So many people are very surprised to see a market rally on the day of an invasion, but this is not the first time. In 1991, the Iraqi war started in, I think it was October, and I think we were in a tightening cycle. Inflation and interest rates were a concern back then as well. And what happened in December? There was actually an easing in monetary policy, which gave the markets a huge lift going forward. So we think that if there is a move in March, there will be one, probably not 50 basis points anymore. And I think the bond market will continue to telegraph that no more is necessary. Let's see, one other point I'd like to make is innovation in the public markets, pure play innovation like ours, is down 60% over the last year. Now, it was up 358% from the low point in the coronavirus until mid-February of last year. We've lost 60%. And at the same time that, our strategy, which we believe is the closest to that of a venture capital fund in the public equity markets, at the same time, our strategy is down 60%. In the private markets, innovation is being rewarded handsomely. There has been no drop in pricing. In fact, quite the opposite. There have been doubling and tripling of prices paid for innovation. So there's a huge disconnect here and a huge arbitrage opportunity. I started ARK for that reason, to exploit the arbitrage opportunity I saw. The private markets valuing innovation at X, and the public markets at half or less of X. We are worse than that now, I think. And in fact, the latest funding rounds for February have been higher than the last, even though we had the terrible downturn in November and then again in January in our strategy. Now, which market has it right? I actually think the private market has it more right because the innovation around which we have focused our research and investing is taking off. Unlike in the 90s, the tech and telecom bubble, many companies had no revenues. Our companies have, except in the genomic space, our companies have significant revenues, $2 and $4 billion companies, for example, 4 in the case of Zoom, 2 in the case of Teladoc. And they are continuing to grow. Many people dismiss them as stay-at-home stocks. But if anything, the world has changed permanently. It's not going back. It's not going to go backwards from better, cheaper, faster, easier, more creative products and services. It's going to move forward. And if anything, in the last year, our conviction in that statement has grown, I'll say exponentially, because we've seen breakthroughs in artificial intelligence that we didn't expect to see for in some cases 20 years, and it's happened in the span of just a few years. So I think the breakthroughs are going to cause incredible business opportunities and winner take most opportunities. Those companies with the best AI expertise, the best domain expertise, no matter which area, whether we're talking about blockchain technology or genomics or robotics, the companies with the best domain expertise, best artificial intelligence expertise, biggest pools of data to identify corner cases, those companies are going to be the leaders of the pack. And in the public markets, we think a lot of companies have not been spending enough to capitalize on these opportunities. The companies in our portfolios and in the flagship portfolio are there because they have been investing aggressively, and short-term oriented shareholders in the last year, because of the interest rate fears, have been punishing our companies for investing in the future and depriving or basically foregoing short-term profits in order to gain long-term benefits competitively. So we're pretty excited about where we sit right now. We know it's been painful. Believe me, I mean, more than half of my own financial assets are in our funds, and I haven't sold any of them. In fact, I've bought. So, and as you know, we bet the company on this as well, and I'm a significant shareholder. So my confidence has increased, understanding all of the risks out there. So George, I don't know if you want to ask any specific questions. I do see some popping up now.
Yeah, thanks, Cathie. Thank you. A few questions have come through. Maybe just picking up on that last point around companies investing in their future and not just looking for short-term gains. What number of the companies that you have in the portfolio are cash flow generative and producing profits rather than just expectations of growth?
Mm-hmm. Well, with the exception of the companies in the genomic space, most of the others are profitable. Now, genomics makes up roughly 30% of the flagship portfolio. And some of them are profitable, but the genomic revolution, we believe, is the most undervalued and underappreciated space in innovation, thanks to the convergence between and among DNA sequencing, artificial intelligence, CRISPR gene editing, and other gene therapies. We are beginning to see cures for disease, and I don't think that is valued in the market at all. In fact, many of these companies, for the reason you've just cited, because they are not generating cash flows, they have been destroyed in this market. Some of our highest conviction names are 15 to 20% of the price where they were last year. You know, so they're down 75, 80%. So just to answer one of the questions here, what if interest rates move up to 2 or 3%? I think that's what's been priced into the market. And the rolling back of those expectations now is why we today had a very good day in the market, and we'll see what happens going forward. But I think the case for a recession is growing here, given the impact of energy prices on Europe in particular. and given the disarray, it seems, now in Eastern Europe.
And given the disconnect you're talking about between the private markets and the listed, and the size of the falls in market value of the listed sector, are you seeing some of the private players come out and start aggressively bidding for these companies and trying to take them private if they can get a markup like that?
It's a great question, and I expect to see it. It's interesting. This is not typically what happens. It's usually more the larger public companies come in and try and import innovation into their sclerotic cultures. I'd prefer M&A to happen from private companies, which are much more innovation oriented, so that our companies won't be smothered by the larger conglomerates. I think the financial markets have been recoiling here, thinking about risk around interest rates, and the M&A activity for our stocks has been, or in our space, has been much less than I would have expected it to be. And I really don't want it. I like our pure plays, and I want them to stay pure plays. But it's certainly, the more this arbitrage opens up, the more it beckons these private companies to buy into the public companies.
Yeah, and you mentioned that, I think it was about this time last year that probably were about the highs for the sector and for the portfolio. And at that point, I think you were optimistic at the time that the forward-looking expectation of I think you doubling every 5 years, which is the threshold for a stock to be in the portfolio, that even at those prices last year, you were confident that over the long term that those sorts of returns will be delivered.
Yes.
Now, I know the word's not quite as simple as that, but simple maths would say that from here, given we've fallen 50-60%, they need to quadruple in the next 4 years to sort of get that back. Do you think that kind of outlook is crazy, or do you think that from where we're at, that you believe those stocks that ARK's invested in can deliver those sorts of returns?
We do believe that, and in fact, our return expectations are north of that. I've never seen this in my career. The closest we got was the end of 2018 after that severe correction. And at that time, we expected a 42% compound annual rate of return over the following 5 years. And you saw what happened in 2020. That was partly the arbitrage closing to some extent. And we did deliver those sorts of returns, up until the end of 2020. 2021, very difficult year. And now we expect returns even greater than what we expected at the end of 2018.
Do you think that sort of volatility is likely to continue in this sector with huge swings upwards as you get the re-rate, and then markets get spooked, short-term investors want to get out, short sellers start influencing the markets? Do you think that sort of volatility is here to stay, but with the general upward trend that you're talking about?
Well, general upward trend, but the bases that these platforms are building here are going to start moving the needle. And so I think these stocks, the stocks in our portfolio, are actually, if Tesla is any example, are going to end up in indexes and will have to be bought by those benchmark sensitive players out there who won't touch something that's not in the benchmark. So I think with time, as these platforms grow in size, just like Tesla became too big to ignore, that the volatility will come down because we will get much more support by traditional institutional players.
Cathie, we've had a couple of questions through on specific stocks. I don't know if you want to go into specific names, but one of them is around Palantir. Is that a name that you'd like to chat about in terms of the
Sure.
rationale for selling it?
Yeah, we love what Palantir is doing. They are one of the leaders in applied artificial intelligence, and they've worked with the government and I think with the intelligence agencies that are way ahead of the commercial world in terms of artificial intelligence and what's going to happen. We sold it recently on the same day that, and this will be a good explanation of what we do in down markets. Roku was down something like 27% of the day after it reported earnings. Palantir was down, I'm going to say 17%. In the Palantir report, there was a fundamental we really did not like, and which management did not address during the earnings call. The government growth rate slowed down dramatically. Now that's the bulk of Palantir's business. And we didn't get a satisfactory answer out of the conference call. So we called around to some of our contacts who have ties into the government from their past lives or what have you. And we learned that the procurement in the government has changed. And the reason, so it's gone from single-sourced supplier like Palantir, which makes a lot of sense when you're talking about artificial intelligence and gathering all the data in one place. From single source to multi-sourced. And I should have thought about this before, but I just thought that national security was much more important than politics. But one of the founders of Palantir is Peter Thiel, or the major backers of Palantir is Peter Thiel. Peter Thiel's aligned with the Conservative Party, and it could have been for that reason that there were these procurement changes. From a national security point of view, we think that's a terrible idea. Anyway, Roku was down for a very down 25 or 6% for a very short-sighted reason. And we always concentrate our holdings towards our highest conviction names as we're going through a correction. What we're doing is we're creating tax losses against which we can take gains as we're selling a company in which we have losses, like Palantir, and we're buying, I'll say, a like for like, a stock that has been hit hard, but which we think is completely misunderstood. It's a big beneficiary of the problems that Facebook and Pinterest and Snap are having now, given the changes to algorithms that both Apple and Google have delivered. So we think Roku is going to be one of the biggest beneficiaries of the shift from the shift to digital advertising and away from some of the social media companies that are not able to target customers for advertisers as easily as once was the case.
Right. And so in this environment where the stocks have been volatile and there's been quite a lot of dispersion, the portfolio process is to take advantage of that through some trading opportunities.
Absolutely. I mean, all of this is published at the end of the day and it's closed, but you'll see that we bought some Tesla this morning at about $719 and it closed at 800. So you get wild swings. We bought Roku that day, as I mentioned, in the 100 to 110 range. And today it is $135. So there are massive moves. And, you know, there are a lot of studies done on the equity markets. And, you know, some of them say if you miss the best 10 days of the year, your returns are cut by more than half for the year relative to what they otherwise would have been. It's very difficult to time the markets.
Yeah, absolutely agree with that. And so you're just to be clear for the listeners on the call, this is a long-term investment thesis. We're not talking about a trading portfolio. We're trying to bounce in out of stocks. What we're talking about here is using at the margins to try and position the portfolio more efficiently. But each of the companies that is in the portfolio is there for the long term. They're not just there for a short term.
Without a doubt, without a doubt. The one exception to that is during periods like 2020, when we could do no wrong, which we knew was not right, but as we see a period like that, what we will do is diversify the portfolio, and we'll add what we call cash-like innovation names that maybe Apple or Google would qualify. But we do that so that when we move into another risk-off position, that cash will be used to supplement some of the names that usually will be hit hard in a significant risk-off market.
And Cathie, maybe just returning some of the questions popped up around PEs and discount rates, which was sort of where we started a little bit. Clearly, if interest rates settle at lower levels than some are predicting, we're going to see a re-rate in markets as PEs can expand again. How much of this portfolio is requiring that sort of dynamic to take place, and how much will the portfolio perform well simply because these are companies that are going to be generating cash flows and profits into the future, and if the re-rate doesn't come or comes later, well, that doesn't bother you too much?
We're not betting on any re-rating in our stocks. We assume in year 5, so in a 5-year investment time horizon, a massive multiple compression. Again, the multiples are high because companies are investing aggressively now. So we expect the multiples to compress to FANG-like multiples or even lower. So that's a given. That's a given. Much more of the returns that we are expecting in that, 40 to 50% range per year are associated with the cash flow that we believe will be generated during the next 5 years.
Right. And Cathie, we're sort of coming towards the end of time, but maybe just a couple of updates on ARK itself as a business in terms of cash flows that you're seeing, inflow and outflow, the current assets under management that you have.
Sure. The last year, our inflows, many people are surprised to hear that word, totaled $17 billion, but it was heavily front-end weighted. If we look at gross flows last year, I won't get this number exactly right, but the gross flows were in the $21 billion range. We kept 17 billion of that. Think about it. They bought near the top, many of them, and stuck with us, probably averaging down, which is a very sensible thing to do. This year, year to date, there were a few days that were big outflows, but I believe we're bordering on flat to now inflowing for the year to date.
Are you seeing? Sorry. So how much assets are currently under the ARK strategy across the different platforms that you?
Yes, we are roughly 40 billion.
Okay. And are you still struggling? Struggling is not the right word, but coming up against those who are aggressively shorting a number of these names. Does that compound some of the odd dynamics that you're facing?
Well, it does, and it does in a way, but it makes the rebound that much stronger, right? Because if we're right, they'll have to cover. But in the short term, this is what makes a market. I do find it very interesting that people, investors, are setting up companies specifically to short our strategy. When most portfolios are short innovation, the way we believe innovation is going to take place from the get-go, I think it's not wise to short innovation for the long term. I think shorting strategies can provide us with liquidity both ways in markets, and that's not a bad thing. But I don't think you would ever have seen such a phenomenon in the late 90s because all investors were tripping over each other to get a bigger technology weighting than the next guy in order to beat the benchmark, which was at 35%. Today, what you have is the opposite. According to the B of A Fund Manager Survey, funds haven't had this low an exposure to technology specifically since 2006. So they've run for the hills, they've run for the benchmarks. And one of the benchmarks, very interestingly, the S&P 500 has 28% technology weighting. Our overlap with that is 0.05%. So think about that. We think that the technology in the S&P 500 is all old world, and that those companies are going to be disrupted by our companies.
Which will hopefully in due course take their place in those indices, at which point you'll probably be moving on from those names and looking into the next generation.
Yes, indeed.
Cathie, we could chat for hours on this stuff. It's fascinating. We thank you for your time and joining us this morning. 2021 was obviously a difficult year for the sector, but it's great to hear your enthusiasm and your passion for where things are going to be tracking from here, and that your conviction in the names that you hold and the strategy remains as high as ever.
Yes, thank you, George. I want to emphasize that our conviction actually couldn't be higher. And it's because we do this research day to day, and we see the opportunities getting bigger, not smaller.
Well, Cathie, have a great rest of day, and we'll look forward to catching up with you again soon, and hopefully in person once travel restrictions start to ease.
That would be wonderful. I love New Zealand, so George, I'm looking forward to seeing you and the team again.
That's great. Thanks, Cathie. All the best.
Thank you. All right. Bye-bye now.
Bye. And we're going to turn now from the global markets and disruptive innovation to a number of the factors that are happening more locally in the New Zealand market, and what we're seeing with the companies here. We've just been through earnings season. And so to take us through that, we're going to be hearing from Michael Sherrock, who is one of our portfolio managers here in the New Zealand equity team. So I see Michael's online. We'll just wait for him to come up and unmute, and we'll be with him.
Oh, thanks, George.
Michael, good morning.
Yeah, thanks, George. Good morning, everyone. Look, I'll touch on the Ukraine to start with. Obviously, the New Zealand markets got hit yesterday afternoon, but recovering well this morning. There's very direct impact to New Zealand from what's going on over there. So from a company earnings point of view, very little impact. Excuse me. And on company earnings, we've just been through a busy period with reporting season. Companies reporting either their half-year or full-year earnings results for the period ending December. And so I'll touch on a few of those shortly. But just prior to that, some of the other things that we're thinking about that impact on companies and the economy in New Zealand. So CPI gets a lot of attention, and rightfully so, given it hits people's back pockets. But in terms of company earnings and the impacts there in terms of costs, there's broad-based costs being incurred by businesses here. So think about rents, think about wages. So minimum wage is up or going up another 6% on the 1st of April. And at that point in time, that will be up to 35% over the last 5 years. And we certainly don't argue against an increase in minimum wage, just the timing and potentially the magnitude of the minimum wage increase over the last couple of years, given businesses and in particular small businesses, the impact that COVID's having on them. And then think about pay relativity as well. So those businesses that are, or those employees that are close to minimum wage will be putting their hand up for a pay increase as well. And then labour productivity is taking a little bit of a hit as well. So think about the sick leave doubling and another annual leave day this year as well. So effectively for each unit of labour, there's less hours being able to be used or productive hours in a year. And so businesses either have to wear that or effectively hire people to cover that if they can find people at all to cover that. And then interest rates rising as well, so that flows through to bottom lines of businesses. And then there's the potential for a redundancy tax or levy, depending on the way the government wants to term it, coming in, potentially coming in next year, which will impact on businesses, but also employees as well. So one way to measure these increasing costs that businesses are being faced with is through the Producer Price Index, in particular the Producer Price Index for inputs. And that number was out last week for the period ending December and just continued its recent run of high prints. So 8.1% for the year, which is a pretty big number if you think about that. And another number that is produced with the Producer Price Index is the Output Producer Price Index. So effectively the price that businesses are receiving for the goods and services that they sell. and that's running about 1% below the input prices. So effectively, a bit of a gap there that businesses are having to wear, and no doubt there's a bit of a lag with businesses able to pass on some of those input costs coming through, but certainly something that we keep in mind. And then from a broader economy point of view, and potentially some of the stuff that Cathie was talking about, the hit to people's back pockets, effectively disposable income, and how that flows on to consumer spending in the next 12 months. So interest rates or mortgage rates going up, and if we use the 1-year rate as a yardstick, I think it bottomed around 2% 8 months ago, and it's now around 3.8%. And there's a lag, obviously, as those fixed rates roll off, and there's around 60% of fixed rates rolling off in the next 12 months. So, that certainly will bite for some of those people on those low rates that have to reset on much higher rates. And then energy costs. So, filling up your car at the pump is very expensive these days, and somewhat unavoidable for a lot of people. So right through to the back pocket there, and you can keep going really in terms of hits, whether it's food or whatever, but ultimately leads to less money being able to be spent, and a potential sort of hurdle for the economy in the next 12 months that we need to think about, and how that will impact on companies that we're looking at. And then throw the Omicron idea into the mix as well, how that plays out in the next 2 months as well. So our role really is to identify those companies that are less exposed, or relatively less exposed, or that can actually benefit from some of these risks or opportunities in the case of certain companies. From there, I'll just move on to reporting season. So it's actually been a really good reporting season. I can't think of too many companies, if any, that have missed either their guidance or the market's expectations. In fact, there's been a fair number that have beat expectations, so that's been really good. Outlook statements are reasonably strong, albeit they have a caveat around Omicron and how that may impact on how they perform over the next 6 months or so. And if I just touch on a few individual stocks, which are sort of overweight positions in our portfolios in general. So Vulcan Steel, which listed in November last year. So they're a steel processor and distributor. So it's just a really good example of how to bring a company to market. It was priced attractively for investors. So it performed well once it listed, and also guidance was proved to be conservative as well. So they've managed to upgrade their earnings outlook twice since listing. The listing price was $7.52, and we bought that across our index relative funds, so the core fund, the SRI fund, and the NZ only fund. It's trading around $9.50, $10 at the moment. In a similar sector, Fletcher Building, so their first half result was a tale of 2 quarters. So the first quarter was heavily impacted by COVID lockdowns in Auckland and around the country. But as those lockdowns were removed, they traded very strongly in the second quarter, and their outlook statement was very strong going forward as well for the full year result. Their balance sheet is rock solid these days, and they're in the process of conducting a share buyback. They're about $100 million through that, and they've got $200 million to go, and they're active in the market in most days buying back stock. I might move on to Sky TV, who reported yesterday. So another business which has been performing well over recent times. They recapitalized their business at the start of COVID a couple of years ago now, and so their balance sheet is very strong. They're in the process of selling a property which should settle next month, which when that settles, they will have $130 million of cash on their balance sheet and no debt, which equates to about 70 or 75 cents per share. But more importantly for Sky TV is their operating environment. So looking forward, they've secured all of the key sports content. So think about the rugby union rights, the rugby league rights. They've got some of the cricket when it's played offshore. They don't have the domestic cricket when the Black Caps are playing at home, albeit they do have the New Zealand Women's World Cup coming up in a couple of weeks. And they secured the English Premier League rights that they announced last week for 6 years. So that kicks in at the end of this year. So once that rolls off from Spark Sport. And so there's a little bit of a question mark around Spark Sport and sort of how they survive going forward, or what they've got to offer customers. But that just really places Sky TV in a really good position going forward. So we continue to like that stock. And if we just move on to Spark, and the idea of Spark Sport being potentially in a little bit of a problem, that's no real issue for Spark, given it's pretty much an immaterial part of the overall much larger Spark business. And we do like Spark from its defensive point of view in these uncertain times. And it also has a very attractive distribution. So they reiterated that a couple of days ago, 25 cents per share, fully imputed, which puts it on a yield of 5.3, 5.5%. They're also exploring separating out their cell phone tower business, which could attract some third-party capital, which would potentially be another nice little uplift for shareholders. Air New Zealand and Auckland Airport, sort of different positions for our portfolios. We don't own any Air New Zealand at all, and we're a touch underweight the airport. These are reopening stories, so once the borders open, no doubt they will benefit, albeit will take a number of years to recover back to where we were 2.5 years ago. And Air New Zealand has signalled they're still planning on raising some equity, which they do need to do. So they're expecting to complete that by the end of March or shortly after. And that could be a big number, $1.5 billion, $2 billion. We'll see where that ends up at that point in time. Might just touch on Z Energy as well. So they didn't report this time round, but they're getting much closer to that acquisition being a done deal, the Ampol acquisition of Z. So Ampol said the other day that they're still on track to complete this acquisition by the middle of this year. Their key hurdle really is around the regulatory side of things and keeping the Commerce Commission happy. So they will need to sell their Gull service station business, and by all accounts there is plenty of interest in that. So that's progressing nicely, and Z put out their scheme booklet yesterday afternoon, which, to no surprise, the independent valuation range has the Ampol bid smack in the middle of that. And now that we have that independent valuation range out, there is the possibility, probably a low probability though, but possibility that somebody else now with that as a reference point might put their hand up and have a look at Z, but we'll see how that plays out. It's still a reasonable position in our portfolios, and a little bit of an upside to the Ampol bid price at this point in time. And then just on IPO side of things, it's been relatively lean over the last couple of months, or couple of years, I should say. And there's not too much on the horizon, albeit there's one or two sort of bubbling around in the background, which we'll keep an eye on, and keep the market up to date with as we can. And so that's those ideas. And just in terms of performance this morning of the market, it's nice to see that it's recovering quite well from the sell-off yesterday, as the US lead has been encouraging. And as I say, from our point of view, we're looking at company earnings and what's going on offshore in the Ukraine, and what Russia's doing has pretty little impact on the companies that we're looking at. So I've rushed through a fair bit there, George, but probably some time for some questions if there is.
Yeah, thanks, Michael. I appreciate that quick run through. Is there anything that you want to add specifically on the Australian market? Obviously, there was a bit of divergence last year between the NZX and the ASX and global markets more generally. How are you seeing sort of the relative valuations between companies on our two respective exchanges?
Yeah, I guess from our point of view, most of our funds are New Zealand index relative. That's our benchmark. And we'll go to Australia opportunistically where we see some value, or if there is a sector or a stock in a sector where we can see some relative value, we'll continue to explore that market. We've made some good money out of Australia. We own Sydney Airport, which was effectively taken over. We sold that down. We've got some data center exposure through Next DC. So we've got a few names. We'll continue to keep an eye on that. Now, the New Zealand market performance last year was effectively flat driven by some of those large caps that had a very strong end to the year prior. If you think about what was going on with some of those energy ETFs or renewable energy ETFs and what was driving some of those. At the moment, we're running ahead of the index for the month to date and last month as well. So it's just nice to see the market recovering from what happened yesterday and what happened in January as well, which was a bit of a headwind on a calendar year performance-wise.
Well, thanks for your time this morning, Michael. We do appreciate it. We've run out of time for this section, so we're going to switch gears and move over to our fixed income desk. I see that Ian Bellew is on the line and able to take us through some of the things that have been going on. We obviously had the RBNZ announcement yesterday. Cathie's talked about inflation, interest rate outlook, and so Ian, interested in your perspective and views specifically around what we're looking at in the New Zealand market as we trek through 2022.
Thank you, George, and happy Friday, everyone. I'd like to start with our view on New Zealand and the world and how we're translating that into what we're doing in the portfolios in terms of interest rate exposure, yield curve positioning, and of course, asset allocation or security selection. So at the end of last year, our concern was that potentially we would have a bit of a rocky start to this year. The last 3 years, the market has suffered heightened volatility in the first quarter of the year. So we went into year-end positioned fairly close to benchmark in terms of interest rate risk. We actually started with a moderate short position, and just in the last couple of weeks we've gone moderately long, given that there's been what we think is perhaps been an overextension in New Zealand interest rates and an overshoot. So we've picked up some longer bonds, more on the trading the range view. In terms of duration, we have had concerns that the US would suffer what we did last year in terms of expectations for higher rates this year. Obviously, the US saw what was happening to other economies last year, but it doesn't really matter until it's happening to you locally. And like New Zealand was last year, the US market has been quite horrified with the prospect of cash increases this year. Although, when we look at the building, the fundamentals, so they really shouldn't be. The reason why we have higher inflation really is fundamentally because of COVID. If COVID didn't happen, we wouldn't have higher inflation. And everyone's aware of the anecdotes, supply constraints, etc. Shortage of labour, why those things are happening at the moment. And to some extent, the central banks have been very pragmatic in the terms that they've talked about inflation being transitory. They've been patient, but now the real concern, locally for the Reserve Bank and also offshore, is that inflation is spilling over to second round impacts. Employees are demanding higher wages and salaries. And also, when you look at the level of interest rates, effectively, interest rates have been close to zero. So, it does make sense the central bank is, taking their foot off the accelerator, is, how they characterise it. So, we think it's, acceptable in this environment that, we do head back to neutral. In New Zealand, that's around 2 to 2.5% on a gradual basis. So, the Reserve Bank does have the opportunity to hike an incremental basis and also review if it makes sense to carry on. And that's, the way that we hope that they'll proceed. New Zealand has a lot hiked in, and we continually write it in the commentaries about how much is hiked in, but unfortunately it just never really seems to be enough. The market wants to keep on pricing more into our curve. And we do think New Zealand looks very attractive on a relative basis to the rest of the world, just given how high our interest rates are, and we are seeing some more offshore investing in New Zealand rates on that relative view. But we certainly won't be immune to what's happening in the rest of the world and the US. So principally, what happens on the yield curve, the front end is more dominated by the actions of the Reserve Bank. So just this last week, we've seen the Reserve Bank come out and revise their projections higher for the terminal cash rate. In November, they expect the cash rate to go to about 2.7%. They're now expected to go to around about 3.3%. And the market was pricing somewhere in the middle, but subsequently we've seen a further increase in interest rates in New Zealand. And from 10 years on, that typically is more heavily influenced by what's happening in the US. So we do think that higher US rates will spill over to higher rates in New Zealand, and that has been happening. But since January this year, we've already had quite a large increase in our rates, in our 10-year rates, and also our ultras at 2051 government bond, which is the longest maturity government bond in New Zealand, has gone from around about 2.8% up to a high of 3.25%, and that's why we bought some longer bonds opportunistically. So that's a short-term view. We are more concerned about rates going higher, but then a long-term view is a little bit different. We certainly acknowledge that the cost of living for consumers has gone up. As the other panelists have mentioned, higher mortgage costs. Essentially, everything is costs more, and it's more difficult, which should effectively slow the consumer propensity to spend. So going forward, we think that we're positioned portfolios for what we think is going to most likely happen in the near term, and that's we're a little bit wary of rate increases, although we will take opportunities to add duration. With this Ukraine thing, we do certainly acknowledge that it does have it does have the capacity to become more serious, but largely the market is shrugging it off. When you look at the bond pricing, US rates has spiked down to around 285, and this morning they're back to closer to 3%. It certainly would get more serious if there was foreign troops committed, but at the moment we've got a bit of a tug of war, I guess, between concern around inflation and geopolitical risks. So we'll just monitor that for opportunities. And when we look at the yield curve, the yield curve has become very, very flat. So if you look at the swap rate, and that's the benchmark creditors' margins are priced over and above, there's only about 10 basis points between the 5-year swap rate in New Zealand, which is around 3%, and the 10-year swap rate. And the government curve is also very flat as well. So we don't see a lot of value in chasing yield along the curve. The way we add yield to our portfolio is that we're underweight government bonds. So our thesis really is that if you buy high quality credit at a higher yield, that should outperform low yielding governments over the medium term. You may get a bit of volatility from month to month, but we do expect those high quality, higher yielding assets to add value consistently over the portfolio on a medium to long term view, and that's why we're underweight governments in the portfolio. Swap rates. About 50% of the mortgages in New Zealand are due to be reset over this year. So we think there will be some pay side pressure as people, do reset their mortgages. Swap margins have already expanded, relative to government. So most swap margins are about 20 to 30 over equivalent government maturity. So we have seen some widening there, but it's something we're keeping an eye on. And also credit, offshore we have seen a consistent widening in credit spreads in those offshore indices. But you have to bear in mind that both New Zealand and Australia are very different markets in terms of supply and demand dynamics. There's still a lot of money looking for a home in the bond space in New Zealand and in Australia. So year to date, we've seen about 8 issues of bonds. Most of them have been supranationals, offshore entities issuing in New Zealand dollars. We've only participated in one issue. We've been, saving our cash for what we think are the best opportunities. So Westpac issued a 5-year bond at a credit margin of 80 basis points, and that was issued at a yield of 3.7%. Australian banks have been issuing, 5-year bonds, the parent company, at around, that's 70 to 80 basis points as well. So we think that's fair on an Australasian view, but we do acknowledge that. Subsequently, Westpac issued a 4-year bond in euros at a margin of 115 over. But that's been the case for quite some time. That banks are prepared to pay a wider margin in offshore markets, and also to get volume of issuance. Still a little bit up in the air about how much supply we're going to see in New Zealand. Given that we've been structurally short the last 2 years. Certainly, the Aussie parent banks will likely be doing more, issuing their term lending facility has finished, and the Aussie banks were certainly quite large borrowers of that cheap money, but they'll want to get some more duration on board in terms of their in terms of their borrowing. We are seeing, the possibility that some of the New Zealand banks, most likely, the issuance that they'll bring to market will be tier 2. So we do have some tier 2 in the New Zealand market issued by ANZ and also Kiwi Bank. That's trading at margins close to senior at the moment. So one view we are implementing in the portfolios in terms of credit are we selling bonds that we think are expensive and investing into credits that we think are essentially more defensive. So we've been selling some of that tier 2, given that we can sell it close to senior credit margins. The Aussie banks, they issue tier 2 at margins about 1.5 to 1.6%. Arguably tier 2 should be issued a bit wider in New Zealand. So that would make it a yield of around about 4%, 4.5% plus in New Zealand. And I think that would be widely taken up by retail. On the government bond front, I think supply and demand. There's a bit of a question mark. There's going to be less government bonds forecast to be issued this year, but also the Reserve Bank has indicated that they'll be unwinding some of the bond buys that they bought through the QE program. So instead of quantitative easing, effectively quantitative tightening, the Reserve Bank is going to sell those back to the Debt Management Office. At this stage, it looks like they've committed to sell back 5 billion bonds a year, and that won't happen until about July. So on the face of that, that it is a negative for supply. But it looks likely that New Zealand has been included in one of the major global bond indices, the WGBI, the World Government Bond Index. And we'll find out whether or not that inclusion has happened in March. It'll be implemented around November. But just looking at similar countries that had their bonds included in the index, it looks like there may be around 2 to 4 billion of buying on inclusion, so that'll be in November, and then maybe another sort of 5 to 8 billion follow up on that. So net on net, our outlook for what's happening to government bonds is fairly neutral. Also, opportunistically, something else we're looking at the portfolios is, we do have a Chinese bank looking at issuing a 5-year bond, and historically they issue about 30 basis points wider than the major banks in New Zealand. So that would put it at a credit margin of about 1.1%. 5-year swap is currently 3%. So you're looking at a 4% handle, which again would be very attractive to wholesale and retail investors. So I'm of view that we're still concerned about that long end 10 years plus. We might sell some high quality, longer maturity bonds that are low yielding, such as Supras or LGFA 33s. We can sell those around 3.3%. Sell a 10 plus year bond and reinvest into a 5-year bond at 4%. Basically, sort of a 60 or 70 basis point pick up. And we do think the belly of the curve, around the 5-6 year is a safer part to be invested at the moment, given their view that interest rates may have still some pressure higher. But as I said, our view on the rest of the year is maybe a little bit overshadowed on the view that the consumer is going to find it tougher, and we don't think all the interest rate hikes that are penciled in will necessarily be delivered. Like as I said, you can see a case for getting back to neutral around 2%, but if we go 3%, I think there's still a big question mark over that. And I'll just pause there.
Thanks very much, Ian. And I know we're just about short of time, so you think about the world in a nuanced and careful way. So giving a 20-second answer is probably not fair for you. But if we were to look forward over 2022, many economists are now expecting a global recession. So we've got this strange dynamic where interest rates are expected to increase because of inflationary concerns. But then, as Cathie pointed out, if we've got recession coming, those things may have peaked. And in fact, actually, the number of increases could well be less than we're expecting. What's your thoughts on what the central banks will do in an environment where the recession does come into the economy? And therefore, do you see actually we'll probably get positive returns from bonds over the remainder of the year?
Yeah, so last time we had the target was, of course, was 2010. So we're just coming out of the financial crisis. Not too dissimilar, but of course, the following decade was characterised by its lack of remarkability. In fact, growth was fairly modest, and the one unique thing was there was no recession in that decade. The first time in about 150 years we didn't have a recession. So I'm not saying everything's going to be exactly similar, but there are some parallels here. I think the greatest risk the reserve banks, face here and central banks around the world is a policy mistake, and I think that's why they'll be prepared to, tighten on an incremental basis and review that decision as they go forward. I think at this stage, I still have a big question mark if we actually go into recession absent policy mistake by the central banks. I think we'll just see things fall a bit flat. You certainly I do acknowledge that higher interest rates aren't good for asset prices. So you've got that double whammy, I guess, if cost of living is higher, and maybe your asset prices, that feel good factor is deteriorating as well.
Well, thanks very much, Ian. We appreciate your comments and your insights, and thank you all for joining us on the webinar this month. I hope that you found it informative as we heard from Cathie Wood, Michael Sherrock and Ian Bellew. Thanks all for your time, and we look forward to seeing you next month. Take care. Bye-bye.